I'm Bryce Butler from Access Ventures, and this is More Than Profit, a show where I talk with founders, investors, entrepreneurs, and leaders of all kinds about living and working with purpose, how they do it, and why. Welcome back to More Than Profit. This summer, I had the extreme pleasure of taking a sabbatical. After 8 years of building Access Ventures, I was super thankful to be able to step back and focus on myself and my family. Therefore, it was a pleasure last month to pass the mic and the host responsibilities to Ben and TJ, who were able to explore a deeper dive into Web3 and NFTs with Sean Cheng. You'll want to check that episode out. And this month, TJ Aboud, Chief Investment Officer, and probably one of the most thoughtful minds out there on blockchain for social good, stepped once again into the host chair to explore the world of blockchain lending protocol that we invested in a couple of years ago. TJ and I have been together since the very beginning of Access, and he is by far the most humble investor and architect of our blockchain thesis. Many of you are not aware that he took what I had developed as a broad strategy around technology for social good and financial inclusion into what has become an impressive and integrated multi-asset approach to investing in blockchain and, more specifically, decentralized finance. On the other side of the mic is Blake West, who you may remember from an earlier episode in Season 3 in an interview I did on crypto loans without collateral. But joining Blake this time is Mike Sall, his co-founder. And between the three of them, they're able to explore with clearly much more depth and clarity the exciting opportunities and implications of the Goldfinch protocol and how it is revolutionizing access to capital in places around the world that have no concept of blockchain.
Welcome, Blake, Mike. Thanks for coming on today.
Awesome. Thanks for having us, TJ.
Yeah, you guys are co-founders of Goldfinch. Blake, you've been on a prior podcast where we've touched on that. I would love to just hear a little bit of how you guys met and then how you decided to become co-founders.
Yeah, sure. I can start with at least how we met. So Mike and I met a long time ago. We were randomly paired together as freshman year roommates at college at Penn. It was funny. I think Penn actually they only asked two questions about people before they came into to Penn. One was like, "Do you smoke?" and the other one was, "Do you get up early?" And neither Mike or I smoked, but I said I didn't get up early, and Mike said he did get up early, and they still paired us together. So I don't really even know what those questions were about, but that's how we ended up together. And we were friends like very early on, and we even worked on projects while at Penn. Worked on like music collaboration websites, and eventually worked on music notation systems, and then like t-shirt companies and machine learning models and stuff. We've just done a bunch of random kind of side projects together since that time, as well as just being really good friends. And so we both ended up at Coinbase, and eventually wanted to start Goldfinch. Maybe Mike, you can talk a little bit more about that in particular.
Yeah, sure. So I remember I think Blake was one of the first people I texted when I first bought Bitcoin back in 2013, getting into it. And I was like, you should check out this Bitcoin thing. And I was just getting really excited about the technology. And then in 2017, seeing Ethereum sort of really start to blossom. And for me, that was a big moment of like an aha moment of realizing, oh, wow, what crypto can do for financial markets. And it felt to me at the time that the next kind of wave similar to the internet, where crypto can do for money what the internet did for information. And I just wanted to be part of that, and talking to Blake a lot about it. And that's sort of what led me to go to Coinbase, was just wanting to focus my entire future career on crypto and making it happen, and loved Coinbase's mission of an open financial system. And so, yeah, that's where we were kind of both at Coinbase. And at that time we were always talking about how does crypto really live up to that promise of really transforming financial systems for the better? And we were both starting to just feel kind of antsy with the whole industry. There's a lot of this activity going on in crypto, but it tends to be self-referential or speculative driven, and not really living up to the promise at the time. And that's both. I mean, there's space for that, but also there's just a cap to what that kind of activity can lead. And so it was both wanting to see DeFi live up to its promise, but then also we need to get the broader actual global economy into DeFi and benefit from all the things that it adds in order for DeFi to grow and just be a bigger space and do the transformation we hope is possible. So that was a lot of the conversations we were having at the time at Coinbase, and what led us to be like, okay, we gotta go start this thing, go start Goldfinch to like actually make this happen.
That's great. I mean, just to start, freshman year roommate pairing, very hit or miss.
Yes.
So then at going to Coinbase, is it freshman year all over again? You both walked in same day, or who went first?
Yeah, I was there a couple months before, and then Blake was thinking about Blake, you were thinking about what you wanted to do next. I remember wanting to being very biased and being like, I really wanted Blake to join Coinbase, but also wanted to give you as sort of unbiased advice as possible. But also just wanted you to join Coinbase. So you joined a couple months after.
Yeah.
Blake, was it unbiased? Did you hear an unbiased advice?
Mike is actually, I think he's pretty good at trying to be unbiased in situations like that. It was enough. He was, encouraging, but not putting on any guilt trips or anything. It was good.
That's great. Well, I appreciate the backstory on how you became partners. So Goldfinch, a lending protocol, we'll get in deeper on kind of what that means. But it's within this world of decentralized finance, or DeFi. Could you just kind of take a step back? Like, what is DeFi? How would you define it?
Oh, yeah, it's a good question. I don't think we've actually specifically been asked that, even though it sounds so basic. But I mean, my kind of conception of DeFi is it is a financial system that it's global, and it is as permissionless as possible, and it's one where everyone in the world can sort of try and tap into the same financial system that anyone else can, right? Where there's no sort of special access or inside deals, that everything is on the blockchain that everyone can access at the same level. I think that is like a really core part. I think also this interoperability is one of the key defining features I think about it, because in today's normal financial system, everything is very fragmented. Every country has a slightly different rails, it's different rules, all sorts of different things, right? But in DeFi land, all the protocols can interoperate with one another in a permissionless way. They don't necessarily need to ask for another protocol's permission to be able to go integrate with them. They can just do that. And so I think that's just really one of those. Those are some of the things. I think global, I think interoperable, and I think equal opportunity for anyone.
Yeah, I would add to that where I think the core defining part for me of how I would define DeFi is just that the fact that no one person owns it. No one entity, no central entity owns it. And so it's open for anyone to build on. And a lot of the early sort of mentality around ethos has come from, I feel like, folks with like a libertarian perspective of like not having like broader centralized powers control it. And that's like one aspect of it. But for me, what's different about it is not about the ownership, but what that enables, which is anyone can build on it in an open way and be interoperable. And the comparison to where that wasn't the case is like you take the early days of Facebook and Twitter, where those APIs were open and developers could build on them, and we started having flourishing app ecosystems. But then those companies over time realized that in order to like maximize their own sort of financial future, they needed to lock that down, and they turned off the APIs, and it kind of like broke that promise with the developer community. And then it makes it harder to improve on it and make it better and add new things on top of it. And so when you have that ownership, you also can kind of like limit the amount of innovation that can take place and the amount of broader impact. But the promise of DeFi is like these don't have central owners from the start. It's like there's no promise anyone has to make with the broader community. It's just baked into the system. And so when there's no ownership and anyone can build on it, and there's this like promise that it will always exist in this open way and in this interoperable way, then that's where the innovation can go crazy, and you can build all these things that are interoperable and connect to each other because we're all building on this open information, this open protocol, this open system that no one can ever shut off. So that's it, like just enables all the innovation. That to me is what really makes DeFi so much so much more impactful and such a big change from the older systems that it enables like this speed of and like amount of innovation that is possible here.
So you're saying that traditional finance doesn't innovate at the same speed of DeFi?
Yeah.
Yeah. It's taken traditional finance over 70 years. We still don't have global instant settlement, and DeFi did it in a couple of years. It was reminding me of another thing where like Mike was talking about how nobody owns it, and that is true for a lot, especially for Ethereum itself. But then within the protocols, right, there are usually still governance mechanisms to change things over time, because change is sort of an inevitable aspect of protocols and just applications. It requires that. One of the things that I think is also a defining feature of DeFi is that the users tend to actually be the owners themselves, and the users tend to have governance rights in the protocols. And so, whereas Facebook and Twitter, especially when they were private companies, definitely the users didn't have any sort of voting rights or whatever on whether or not those APIs would change. But in the DeFi landscape, it's kind of by default that the users receive some sort of token or some ability to have governance power. And I think that is also just a really critical piece, because things do need to change. But DeFi is going to be the system that allows for all of the kind of stakeholders in the room to actually have a stake that's like meaningfully, can't just be overrun necessarily. And if they can get the votes and enough people want it, then things will change in the right direction.
Yeah, I think we just saw that with Maker recently, where there were some proposals that went against the ethos of the protocol, and the votes came out in droves. People upheld the mission. Yeah. Okay, so Blake, you talked about everyone. This is global in access and equal. So who uses DeFi? Yeah,
DeFi right now, it's being used by just a huge range of people, right? I think, and this is actually one of the things I find very interesting about crypto generally, is that the range of people and locations that are using crypto, to me, speaks to how it is something that is truly new and doing something really different. So like, obviously you do have people all the way at the very top, right? You have very rich crypto individuals using DeFi just to like make profit and trade and things like that. But then also, you have people in emerging markets trying to use DeFi to hold dollars in their wallets because they're afraid of inflation in their countries, right? So people really at the very top and the bottom of the pyramids, both trying to tap into the same network. And that's what's awesome about it, is they both can tap into the same network and they both play by the same rules there. And so then you have stuff like what Goldfinch is doing, where we're lending to companies all around the world, over 20 different countries, and those companies are then taking those dollars which are sourced from the crypto ecosystem and loaning them out to small businesses and individuals throughout the world. So they're being impacted by DeFi, even if they're not directly tapping into it. And then you also, of course, have middle-class people all over the world in developing countries also trying to tap into DeFi just to do trading activity or to earn better yields on their savings rates, or to send money across the world and remittances and things like that. So there's a really wide range of use cases and a wide range of countries and types of people using it, which to me is just makes it. It's a real good signal that it's something special.
That sounds about right to me. I think one of the things that was surprising to me, honestly, was when we got started with Goldfinch and kind of announcing, and we created the Discord for the community, and we started seeing folks come in, and the folks who joined are just like from all over the world. I would say the U.S. was like a minority of just the general community in Discord, and the folks who are excited about it. And we don't know exactly who the people are that are using the addresses that are interacting with the protocol, but just based upon who's participating in the community and talking about it, it's like very global from the very beginning. And I think that points to kind of what Blake was describing of how just the global nature of DeFi is really a big part of it, and that it is spanning all of these markets around the world of the kinds of folks who are using it.
That's great. I mean, it's just a huge cross-section of users. And I often forget that stablecoins in and of themselves are a massive use case for folks just gaining access to US dollar. That's huge. So for those that are maybe looking for yield, so not the folks that just want access to the US dollar, where do the yields come from? Maybe like a compare and contrast, because they come from a lot of different places, but what you all are doing at Goldfinch looks a little bit differently. So maybe compare and contrast.
Yeah, sure. This is a big thing about Goldfinch that is different from a lot of what else is in the DeFi space. So I can talk about what's going on broadly in the DeFi space, which is there are a number of kind of decentralized exchanges and decentralized money market protocols where you can lend and borrow, and the users of these protocols tend to be traders, and the source of the yield on these protocols tends to come from two things. One, it comes from when these traders are borrowing capital. They're basically trading on margin, and so they pay interest on that capital. They also will pay fees when they are exchanging, so they pay trading fees. And so a lot of the kind of fees or interest or source of yield that's going to folks who provide capital is coming from all of that trading volume. And the second thing is that what happened at the beginning of the DeFi summer in 2020 and going forward was a lot of protocols using what's called liquidity mining, basically taking tokens from the protocol and giving it to the users as part of kind of bootstrapping activity and providing this extra source of yield. And so it's also driven by the token is another source of yield. So for most of DeFi today, where the yields are coming from is the trading volume fees and trading volume driven like margin interest, as well as just the token subsidies that these protocols are providing to basically encourage and incentivize providing the capital. And that drove a ton of activity and like a ton of fees and a ton of great yields. The tricky part of that is when a bear market starts to hit, because when prices start to come down, as we saw over the last couple of years, two things happen. One, token prices, just by definition, are falling. So the kinds of yields you can get from those subsidies are just falling because the tokens you're receiving are not worth as much. And then secondly, the trading volumes also decrease. In a bear market, there's just like less volume overall. And so all of those fees decrease. And so what we see is the yields fall significantly, and so that like really creates a lot of volatility in the yield. So like for example, on places like Compound and Aave, these are two money market protocols where a lot of margin trading is borrowing capital, and you provide crypto that you lend to the borrowers. The yields there were in the range of say 5 to 10% when the markets were going great, and then now on both it's sub 1% in terms of yield. So it's a pretty dramatic change, and that tends to be the pattern across a lot of these protocols when the source of yield is connected to the crypto activity in the crypto markets. Which leads to the big difference about Goldfinch, and it was a core part of what we were trying to build from the very beginning, which is bringing on the source of yield, bring on borrowers who are not getting their yield from the crypto markets. These are small businesses and fintech companies all around the world in different markets, and they're using the capital to lend out to small businesses and consumers in their markets. And so the yield and the interest that they're paying is driven by their local markets and their local economies, and it's not connected at all to the crypto space, which means that the yields are more sustainable. And even when the crypto markets are like having a downturn at the current moment, the yields on Goldfinch have stayed the same. So, for example, the senior pool on Goldfinch, which is kind of the aggregated pool, the rates there were in the range of 7 to 9% before the market started falling, and then now it's still 7 to 9% because it's driven by these companies in 20 plus countries around the world that are lending out to consumers and small businesses in their markets the same way they were doing a few months ago. And so that's one of the big differentiators of Goldfinch, which is that the yields here they're really not connected to the crypto markets. They're connected to these other businesses around the world. So yeah, that's how we kind of think about the yields and sort of a compare and contrast there.
Thanks for sharing that, the compare and contrast. This is probably a little Greek for most folks. So how do lenders and borrowers come together on your platform?
Yeah, so the way that this works today is borrowers who tend to be fintech companies in emerging markets, they basically present a deal to the protocol community. You can kind of think of it like they're syndicating out a deal. And so there are actually two types of investors on Goldfinch. There's what we call backers, and then what we call LPs. And so the backers are sort of actively assessing deals and deciding whether or not they want to put their own money into those deals. And so to kind of then the LPs sort of put money into this aggregated senior pool that Mike was talking about, which automatically follows on to some of the investments that the backers do. So to kind of walk through that, these borrowers, again, who are companies, they're not individuals. These companies come and they say, hey, I want to borrow $1 million. I'm willing to pay this rate. I'm going to pay back at this frequency, et cetera, et cetera. They then also present like data rooms and all this information. They go into Discord channels and provide, say, hey, if you want to ask me any questions, you can do that. Some have done YouTube AMAs. So they really try and present a lot of information to backers so that backers can make an informed decision about whether or not they want to put their money in there. And they put that deal on Goldfinch, and then backers can put capital in. And so if the backers are putting enough capital in, and the protocol sees enough backers doing that, then it will add on capital automatically from what the senior pool has. So then the senior pool adds on its capital, and 20% of the interest from the senior pool is reallocated to the backers. And so that's part of what gives the economic incentive for backers to do this diligence work and this assessment. And it's also important to recognize that the backers' money is first loss. So this is how the protocol really knows that the backers believe in this deal, because the senior pool is protected by the backer capital, which typically is about 20% of a given deal. And so that's kind of the high level, right? The borrowers bring a deal, backers put capital in, capital is then additionally allocated from the senior pool if there's enough backers and enough action we're seeing put into them. And that's basically how it works.
I guess I'd liken it to maybe buying a house where you get 80% from a bank, and then there's the 20% that you bring to the table. Or let's say you ask some folks to help you finance the extra 20%. When the house sells, the bank's getting paid first, and that's the senior pool, protected, and then that makes a lot of sense. And so in DeFi, the other protocols, they're considered over collateralized lending, where you have to put in, call it $2,000 to be able to borrow $1,000. And so Goldfinch has been categorized as under collateralized lending. But Blake, you had just a great tweet recently addressing that label. If you could, I'd love for you to go a little bit deeper on that.
Yeah, sure. What I was kind of getting into in that thread was how, people have been calling Goldfinch under collateralized or uncollateralized lending, and I was just getting a little frustrated about continuing to hear that, because it's really just not very true. The loans on Goldfinch are in fact actually over collateralized, and they're over collateralized by off-chain assets and income. And I think in the crypto space, it sort of just was a bit of an accident of history that the very first protocols that came up were, everything was all over collateralized with on-chain assets. And I think this really became a point of confusion among protocols, because then like when Goldfinch, and there are other protocols that also do lending with off-chain assets and using that as collateral instead, they all kind of needed to, I guess, differentiate themselves. And for some reason, sort of the way that differentiating themselves came to be called was, they're over collateralized with on-chain, we're under collateralized or whatever. And so that just sort of became the term, and it's just wrong. The loans are in fact over collateralized with off-chain assets, and collateralization just in the general finance world is kind of a per deal aspect, right? Some deals might be under collateralized if the borrower or the asset is particularly trustworthy. Other ones are mostly going to be over collateralized, kind of more standard. And so I think both protocols are actually probably going to end up doing both, right? They're going to have a mix of off-chain and on-chain assets, because to only have on-chain assets, it works very well in the compound Aave case. It's very efficient. It's like fully automated, and there's very little risk in that system. But I think to really expand to all the use cases of lending, we're going to need to start taking into account assets that are off-chain as well. And so Goldfinch focuses on that, but I think eventually Goldfinch will probably also take into account on-chain assets that people have. And as I bet, Aave actually has a version of taking into account or doing, quote unquote, under collateralized lending, this like credit delegation thing where people can take their credit limit and just give it to someone else, without any sort of, collateral being given, or at least none that's on chain. And so I think, really we're going to start to see these things kind of converge, and we're going to more respect collateralization as just sort of a detail of any given deal.
Yeah, it feels very very traditional when you start to put together the blocks of traditional finance lending and DeFi. And I think some of that's almost in the shadows for folks that have really come to learn lending through DeFi.
The building blocks of finance, like, they don't really change, right? Like, and the notion of like risk and how to assess risk and calculate risk, DeFi doesn't fundamentally change any of those things. I think sometimes, within the crypto space, people sort of pretend as if it does, but none of the risk stuff really changes with DeFi. What DeFi is giving us is these other things that we were talking about earlier, right? It's giving us a system that nobody controls. It's giving us a system that is interoperable, that's global, and that is where it's equal opportunity around the world. And I think those are really, really important things that unlock a lot of value. But the fundamental aspects of finance and whether or not something is risky doesn't change, and DeFi doesn't fundamentally alter that.
Man, I'm glad you brought up risk. Given what we've seen over the last month or so with things like Terra Luna, BlockFi, Celsius, I mean, there are a lot of users of that. And the risk, I mean, it hides in plain sight for most. And so how does one assess risk on your platform?
Yeah. So, yeah. I mean, the big difference I feel with systems like Goldfinch is and just DeFi in general is the transparency and being able to, like, you should be able to point to exactly where the yield is coming from, and then you should be able to assess it and determine if you think it's good. And so a lot of these companies that are struggling right now, like Celsius, for example, they didn't say, like, they never said where the yield was coming from. They would say whatever the percentage was it 8-9%? And then that was it. And I spent a lot of time trying to dig in, like, understand, like, where is that yield coming from? They never said, even if they had said, like, oh, we provided to trading companies, which is actually, like, kind of similar to what Compound and Aave do, when we think a lot of the folks who are using this are using it for trading, but it was very sort of opaque there. And then that makes it hard to evaluate. You just have to, like, take someone's word for it, and they're not even providing much explanation. Whereas on Goldfinch, like, the way you would assess the risks is you can see every single borrower, and they share a bunch of information about here's exactly what we're using the money for. So, like, there are all of these, we call them pools. They're essentially like loans, but they're the borrowers put up the pools that they're proposing, and they say, we want to borrow this much money, and here's what we're going to use it for. And they provide a whole bunch of information. They share, here's our team, here's our approach to lending out this capital, because they're all lending businesses. They put together data rooms that are often behind NDAs, because it includes a lot of information there, and so you can go in and sign the NDA and view detailed information about their borrowers and their lending practices and how they evaluate the different risks and, like, what their risk framework is, and just all of their sort of, like, guiding parameters of how they use the capital. And then they'll also provide even often more detailed examples of, like, specific types of borrowers. And so that is kind of like a traditional loan, where you want to look at who the borrower is and understand what is their capability to pay back, how, like, what makes them such a strong borrower. In the case of Goldfinch, it's these fintech and lending businesses that have years of great track record, where they have shown their ability to use the capital profitably and pay back all of their debts over in the past number of years. And so you can look at that, and so that's a big I think general promise of DeFi, is that you should be able to, like, look at every single dollar, like, where is it actually going, and then look at that place it's going and evaluate what are the risks. And so there are risks the way there are with any kind of a loan, where you want to understand who the borrower is, but the big part is being able to look and see who they are. And then another part of it too is when you compare it to other sort of platforms where they're like, oh, we're going to generate this yield with doing different things, and they don't say why, or they don't say exactly where. With Goldfinch, you can look at the borrower pools, and then you can see the borrowers, and then you can, like, go talk to them. So not only do you like look at their data rooms, but you join a chat room or a forum with them, or you just reach out to them, and you can, like, ask them questions directly. That's part of what this, like, openness involves, is, like, there's kind of like no limit to what people can do in terms of their own assessments, and it's all transparent.
And also the pools and the payments are all on chain. You can see that, and there's, that's very, very transparent. It's transparent as it gets.
Oh, yeah. As we look forward, the on-chain repayment, I mean, it's a public credit score for banks that typically you don't really understand their health. I like that aspect of it. And as a recovering banker, going into the deal rooms has been nice because you really can understand it with a skilled eye. And so when we, like, from a traditional finance or TradFi mindset, crypto at large is just kind of this risk on asset. It's stocks multiplied by more risk. So that's how folks think about it. But it sounds like what you're talking about is more of a risk off asset, whereas the yield is a little bit more predictable and safe. Would you agree with that?
Yeah, I mean, I don't know if I guess we're going to draw on and off risk. I mean, obviously the things on Goldfinch still have risk, but it's certainly a very different type of risk than the risk that's normally associated with crypto. Whereas crypto is typically, more like equity style risk, where people think about it as like, maybe 100x and hey, maybe it'll go to zero too. Like those are kind of the outcomes that you think about when you're investing in like, Ethereum or Bitcoin.
I would just add maybe some of the return profiles. The closest comparison maybe we have is sort of like equities, but it's just not equities. So I feel like crypto is its own thing. We're sort of learning how to evaluate it differently. So I feel like the comparisons to equity get a little bit loose pretty quickly. But yeah, what crypto does demonstrate is like really large potential upside.
Right, large potential upside or large potential downside is how people think about it when they invest in tokens. But certainly on Goldfinch, it's not like that, right? These are credit instruments with fixed rates of return or variable rates of return, but it's within a much smaller window, and like you generally wouldn't expect it to go to zero. That would be like highly unlikely. But it's never going to go to 10x, 100x, right? So the kind of the return profile is much different. And again, certainly not risk off. Like it's not like it's riskless in any way. You still have to do a lot of your own assessment to make sure that it fits within your risk appetite. But it's certainly a very different type of risk than what is typically associated with crypto.
And that's something, this just feels like it appeals to TradFi investors. So more institutional shops that understand this kind of lending, this real world kind of lending. So what would flip in their mind? Or what needs to flip for them to begin to see this as maybe a form of fixed income security as opposed to an equity-like security?
Yeah, there's different ways, I guess, to kind of participate in Goldfinch, but if we're talking about specifically providing capital that is used as lending capital to borrowers, like when the backers are providing capital into individual borrower pools, that they're entering into a loan agreement directly with the borrower. So that is fixed income. That is like a credit-based return profile. I think for traditional finance folks looking at it, is basically a very similar thing, and what it would take for them probably is just to understand a little bit more about like what is Goldfinch doing differently here, and just like it's really making it more open and making it more transparent. And Goldfinch will probably need to keep building up its own track record to just show how it is similar to existing kind of fixed income options. And then also a big thing that Goldfinch is doing is just expanding access to these deals. So a lot of the kinds of borrowers that are coming into Goldfinch, the way they typically get the capital is they will do private credit deals, either with credit funds that focus on these different markets, or like family offices that tend to provide capital directly to these businesses. And you kind of have to know the right people to be able to participate in these deals. And so they're like these private deals, and it's like really attractive interest rates, and these like are really high quality businesses. But it's like pretty hard to go, if you're like in the US, to like go do a private credit deal with like a company in Indonesia. It's just like not that easy to do, which is why it's just these smaller credit funds that tend to do it. And to participate in those funds, you have to be a qualified investor and have millions of dollars. And so it's just like a very kind of like closed and private system, but the deals are really attractive to a lot of folks. So that's the other thing about Goldfinch is like the deals are there. They're like, they're more like anyone can really participate in them. And so that opens up the accessibility there. And so it's the combination of just showing that that the deals are very similar. It's just what Goldfinch was doing here is making it more open and making it more accessible.
On that side of it, so it expands access on both sides to the lenders and the borrowers. Now borrowers have a new outlet for funding that isn't a private credit fund. And so because the way it's facilitated on Goldfinch, it's largely driven by, it's a smart contract. And so it's very efficient. So recently the IMF did a study of DeFi versus kind of traditional funding methods in emerging markets. And so that report said that a DeFi infrastructure is 12% more efficient, which is not a small number in the lending game.
And so finance, yes.
Yes, it's a big number. And so I have a couple questions for you. One, so the savings particularly come from personnel and OpEx. And that's intuitive when you are removing layers here. So I guess one question is, does the removal of personnel and OpEx, does that have relevance on the risk assessment of these loans?
It's a good question. My first instinct would be, and so I haven't read the report personally, but this is interesting topic to discuss. My first instinct would be that it doesn't affect the risk assessment, except to the extent that it might affect your return by making the return better if it's cheaper to overall do the deal, and so sort of your risk adjusted return might be like a little bit better, which might maybe gets it over the line or something. But I feel like the risk itself would still be the same unless you're kind of getting at something else with that.
I think there are. And there's also like, is the risk affected literally today versus when you think about where this could go in the future? Because today a lot of the benefits are with the efficiency of like, it's actually like just easier to make a crypto transaction than to do sort of like a cross-border wire, and sometimes the banks will just like straight up deny the wire, so you have to like let the bank know ahead of time and then see what the wire sort of caps are, and then maybe you have to break it up into a couple wires, and it has to maybe bounce around a couple of banks, and it takes a few days. And so like with crypto, you just do the transaction and it shows up within a few minutes, and it just saves like a week of time and hassle there. And so that's just straight up like an efficiency benefit. It doesn't necessarily change the risk of it that much, but the place where it can start changing the risk is that when you start to have visibility into the capital. And so if the counterparty is holding on to, say, instead of holding on to USD in a bank account or holding on to their local currency in a local bank account, they're holding on to, say, USDC on an address, well, you can see that. And so what often would happen with, for example, what happens traditionally with a lot of credit funds that do these sort of really advanced kinds of deals is they require the counterparty to give them access to the bank account, or visible read access. So you can actually just log in and you can see your borrower's bank account, you can see their assets, and you can monitor it. But you have to do these complex legal agreements and get connected and get all the their get accounts with their banks and things like that. And so there's just a lot of just friction in setting that up. Whereas if you have a counterparty on crypto and they're holding on to funds on crypto and you can see it, that there's efficiency there. You don't have to get bank accounts and stuff to be able to see that information. You don't have to get audited reports of their financials. You can just actually see the information there. then that is actually reducing the risk, because you don't need to like trust auditors. You don't need to like get their bank account information to be able to like see their financials. You just like see that information directly on chain, and then you can have a lot more confidence in the things that they're describing, and just like their straight up ability to pay. So like I think we're actually pretty close to getting to that kind of a stage. Like right now, a lot of these places won't hold a lot of their capital on chain, but in some ways it's easier to do it. And then once they start doing that very quickly, it will have a direct impact on improving risks, because you can just see that information. You don't need to like get all these additional confirmation or like access to like have trust in sort of that information.
I might also add there that, like Mike is saying, once people start to hold their bank accounts on chain and their flows of funds start to be on chain rather than off chain, like there's a lot of things that open up. In Mike's talking about transparency stuff, which is huge. But also, you look at a lot of these deals will have what are called covenants, and covenants are basically rules that say like, oh well, like if your default rate drops below X%, we're going to stop lending you as much money, or this interest rate's going to kick up, or blah, 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 right? So all these things are usually based on the performance of the borrower. And if all those flows and funds and stuff are on chain, you can actually make all those covenants automatic, right? They can all be living on chain, and you can know exactly when the performance of borrowers is changing in real time, and start either saying, well, okay, we're going to stop lending you out money. You're going to need to start bringing stuff back. These rates are going to increase. And those things can be encoded in a way that really does reduce risk. Right now, those things will happen maybe on like a quarterly review or something. You'll be like, well, hey, borrower, can you send me some stuff every couple months, and we'll have a meeting and talk about it and look at your numbers, and then maybe I'll do something about it. Whereas I think the crypto and blockchain really has the promise to make that a lot better. Similarly with things like escrow accounts and SPVs, things where these borrowers have to usually open up separate bank accounts where they put some of the funds or some of the assets in that thing, and it's controlled by this third party who charges fees to manage that thing. Again, smart contracts can eliminate all of that. And if you think about all these kind of legal and third party and sort of intermediary things and covenants being done too late, these are a lot of things that actually do come into the risk of the asset that can be achieved when crypto becomes more kind of fully integrated into a borrower's financial life, which today it's not there, but we're going to get there.
Those are really helpful thoughts. It helps expand my thoughts on the efficiencies a little bit as they affect risk. I took a little bit different view on it. Is that when you're working kind of the traditional way of underwriting, you are attracting and retaining and improving the skills of just purely underwriting. So the assessment of risk in that case. So a credit fund has loads of analysts that understand markets and repayments and lending dynamics. And though Goldfinch facilitates that, you provide all of the same information that a credit fund would have. To me, the question is, are they a riskier borrower that maybe a credit fund wouldn't lend to, or would take maybe a different leverage ratio in mind, that maybe Goldfinch doesn't yet have that expertise speaking into the lending decisions? So that's how I thought about maybe the personnel piece might lead to a little bit riskier loan, but it's an unknown to me. That was just something I was thinking about as I read the report.
Yeah. I would say that's an interesting question about whether or not those kind of personnel things would matter. I think one thing we're hoping is that by design, the sort of people doing the assessment of the loans are putting up their own capital into those loans, and they're in fact going to be the first loss piece. And so we would hope that makes them really attuned to the risk, perhaps even more so than analysts who are not putting up their own capital into typical private credit deals.
And I guess there can be a syndicate of sorts where the backers are actually the skilled credit funds because they want access to the deals, as the borrowers tend to prefer Goldfinch over time. So it could be one of those things where it actually grows into, like you said, a much better risk-adjusted return. And so if there are 12% savings, who gets that savings? Just the lenders and borrowers? Is it a one-sided benefit, or is it shared?
I'm curious about both things, but I think it will go primarily to the borrowers. And the reason is because when something is riskier, you need to command a higher rate of return. And so that rate of return comes up in terms of charging higher interest rates to borrowers. If you feel more confident in the borrower because you have these other sources of assurance, such as how the loan is actually implemented and the way it's going to be kind of serviced, well, then you could feel comfortable charging a lower interest rate. And so I see a lot of those benefits going to the borrower. Borrowers often pay a lot of these fees to get capital, and then they pay the interest rates. If we're able to reduce risk and bring down the cost of capital, that should help borrowers get capital at lower rates, and then it leads to all the economic growth that happens when you can have a lot of borrowers getting more capital. So that would be my guess, is it would be more lopsided towards benefiting the borrowers.
I guess that seems reasonable to me. I'm not totally sure. I think my first instinct would have been kind of shared, but I guess I don't really know. Because if you're kind of reducing the risk, I guess if you reduce the interest rate, that should reduce also the amount of people who want to supply at that interest rate. But if risk across the whole system is brought down, and just like the sort of net rates are brought down, then maybe it'll be same amount of investors in them, and then also more deals are possible. So it could be more supply of deals as well with lower risk. So.
Yeah, I would add to this. I think where it helps the lenders is the long tail of lenders who don't get to participate in these kinds of deals today. So I think like the richest folks who participate in these credit funds, they're getting great deals today. I don't know if like they're going to benefit from a more open, interoperable system. But in a system where we can bring down the cost of capital, we're able to get more capital out in the world to borrowers at lower rates, and at the same time, more people around the world can participate in those deals. So like the more typical, like everyone else except for like the very top of the investor base will now have access to these much more high quality, like higher yields than say like a few bips on a bank account in the U.S. But maybe that will be where I think lenders can like really benefit. It's just by having that access to these kinds of deals.
Yeah, I guess my intuition on this is it would be shared. As the market kind of settles these dynamics out, it would be shared. So as an investor in a private credit fund versus using Goldfinch, there's no management fee, or not a large management fee on Goldfinch like there is a credit fund. So you already have like a little bit of kind of risk-adjusted return there. But then if the borrower has a lower cost of capital, it doesn't necessarily have to be so many bips that it can't be shared, because at the end of the day, you're building a marketplace. And so the more attractive it can be to the money flowing in and the borrowers, everybody benefits. So my intuition is it would settle out somewhere, and it would probably fluctuate based on market dynamics on where those efficiencies go. But I look forward to seeing how it works out over time. So, I want to close out with just a couple of questions that just I always find interesting when speaking to founders. So the first one being, what keeps you guys up at night?
The crypto space moves so fast, and things that just weren't there a few months ago are suddenly like the biggest thing happening in crypto a few months later. And so I feel like a big part of participating in this industry is trying to see where everything is headed, keeping tabs of what's going on. And so I wouldn't say it keeps me up at night, but like something that like Blake and I are often talking about is like, where are the trends headed? What are the big things? How do we make sure we're can like help the Goldfinch community be sort of responsive to the changing sort of macro environment, and that like we're like, because things can change so fast and significantly. So that's just like a broader theme, is like we're constantly sort of talking about, okay, like what are the big things happening, and how do we make sure we're setting up the Goldfinch community to be like helping them like be in good shape for like new things that might happen.
Yeah, I might add on to that. I think like a lot of the risks in a company is usually the things you're not thinking about that sort of end up, 6 months later, you're just like way behind the ball, or that you just like missed this underlying risk of your system that you weren't thinking about. And so, yeah, trying to think about either those trends in the industry or just underlying sort of like mistakes that we're making. Mike and I actually have a weekly, we call zoom out time, where we try and actually sort of really take a step back and ask questions that are like, are we making mistakes on something? What's like what are issues that we might not be seeing, or what are trends that we could be capitalizing on that we aren't thinking about right now? And we found that time to be very, very helpful for trying to find out those things. I think otherwise things that keep me up at night would just be honestly like what if there was some sort of like, I mean, we are seeing there's potentially a real global macro bear market that could be ending, could be happening right now. And, I do worry if that happens and it somehow globally affects borrowers around the world, then that could be a huge problem for Goldfinch. Obviously, we're trying to build as resilient systems as we can with really high quality borrowers, but those things are always possible. And I view that as a real risk. But then again, we thought about that too. And that's why we try and actually be in as many countries as we can to try and diversify that risk. Hopefully not like everything really goes poorly for everyone at the same time. But that would be a bad thing that I do worry about from time to time.
The one thing I would add, Blake, is that I'm assuming the newborn keeps you up at night a little bit. Sometimes.
Yes, sometimes. Yes, I do have a newborn who is about 4 months old right now. And yes, sometimes she does keep me up at night too, though. That one was not Goldfinch related.
So I like that practice of doing that Zoom out meeting. So if you guys had a crystal ball, where's Goldfinch 5 years from now?
Yeah, that's a great question. Let's see. So, what we really think about with Goldfinch of like where we think about like where the world is headed is we think we're headed to a situation where economic activity is increasingly moving on chain, and there is a growing investor base that's looking to have access to new deals. And kind of our original sort of thesis behind starting Goldfinch was that we think there's going to lead to a situation where every transaction that people are doing in the economy is basically on-chain and programmable, and there are investors who want to provide capital towards those transactions, and it'll be a situation where like anyone can basically lend toward any transaction that's happening, almost as if like Visa rails became open source and it wasn't just big banks that could provide capital towards those transactions, but like anyone could, or even a smart contract. And so we're gonna need it's basically a marketplace, and we need a protocol that can kind of organize this kind of a marketplace. And that's really where we see Goldfinch headed, is to be this organizing mechanism for this marketplace where all of this economic activity that's happening, anyone in the world can provide capital towards that economic activity. And so, I mean, that's a lofty goal. That might be more like 10 years down the line, like truly. But even in 5 years, I would hope we start to see that happening with Goldfinch, where we see folks all around the world in a scalable way coming to Goldfinch to get capital for productive economic uses, and all sorts of people all around the world are providing credit towards those transactions. And we are able to see them on chain, which is providing the transparency we described, is helping to reduce the risk we described. And we're starting to see like the real benefits here of what DeFi can do with interoperability and openness by providing more of this capital all around the world to this kind of economic activity.
Yeah, I think that's great. And I would just add on a couple things that I would hope that within 5 years, it's like right now we sometimes talk about, we feel like we're like Netflix pre-streaming and we're still like mailing out DVDs. Like we're doing this thing, like it is better. We're using crypto to get the money in the hands of all these people around the world and closing this financing gap. But like I think within 5 years, we'll hopefully start to see more of the streaming side of things, which is, as we were mentioning before, like all of these flows, not just to the company initially, but to their end borrowers, are all happening on chain. We're starting to see much better transparency, which allows for much better price entity assets. We're starting to see some of these things I was talking about before, of being able to move away from random SPVs in different countries and just having a simplified system that everyone around the world can use. Just spin up a smart contract and you have this kind of custody provider right there, in the sense of the smart contract being that intermediary. And then you're starting to be able to do things like automated, covenant analysis and changing, parameters of deals based on performance in real time. Like I think starting to see a lot of those things really, really come into fruition. I would hope we're definitely there within 5 years.
Those are such tangible examples of what the promise was and has been for this technology for years. open access and smart contracts, building efficiency and transparency. So I appreciate you sharing that. We love your mission here at AV. Our disclosure is that we've invested with you guys, but opening access is so important. Bringing people into the economy that haven't been there before or have been excluded to one extent or another.
To learn more, check out goldfinch.finance or shoot them an email at hi@goldfinch.finance. They love to hear from people. As always, thanks for listening, and stay up to date by subscribing wherever you get your podcasts. And while you're there, drop us a review so others can find us as well. More Than Profit is a production of Access Ventures. Direction, design, and editing is done by our friends at Render, a public benefit innovation studio in Louisville, Kentucky. To learn more about their work, check out workwithrender.com. As always, I'm Bryce Butler with Access Ventures. Thanks for listening.